And we're off to the races. Q1 earnings season just kicked off with the fun only getting into gear on Friday. And while time does fly when you're having fun, or in our case, when you're making gains, there's still a whole lot of data that we need to get through. So today we're going to look at what we can expect for earnings this Friday. We're going to be diving into some of the heavy hitters in the financial space. We're also going to be talking about inflation and its ramifications for the market right now, and politics. The election inches closer every single day, and we're going to be diving into policy, the economy, and everything in between. So sit back, relax, and let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Cheers. Okay, this is the daily heat map of the S&P 500, and guys, there wasn't much to talk about today. It was a very flat day, very low volume, very thin and muted range. The best performing sector was right here, financials. This entire sector is running up into earnings this Friday. We saw regional banks actually put out a very green day, along with names such as Tesla, Google as well, right? Software application right here, and I think these are probably riding the flows of what Google announced with AI, Screen AI this weekend, as well as Tesla Robotaxi. I think as a result, this part in technology, software, just caught a bit as well as a result. Other than that, it was pretty red across the board. We did see a bit of a defensive rotation here in utilities. Very, very interesting. I think that just has to do with leading up into the CPI, PPI prints later this week. But other than that, you know, last week's winners gave back some gains. Look at XLE, GEX. And then we saw, for the most part, most sectors did gain. Stuff like semis, metals, software, financials, utilities. They did beat the SPY by a substantial margin. But stuff that underperformed the SPY was stuff like technology, staples, healthcare. There was no real leader. It wasn't cyclicals. It wasn't defensives. It was just on a day with thin leadership and thin volume. We just saw these names move higher. And again, you could definitely tell there was no real leadership because rates did move up marginally, and we had real estate, perform really, really well. Regional banks as well. Utilities, these are like the most rate sensitive names in the market. So not much to go on with today's trade. When it comes to thin volume, you can see weird stuff happening to the market. I wouldn't read too much into anything that really happened today and really wait for volume to pick up in the market before we can actually discern any substantial trend on the day. But let's actually hop on the charts and I'll show you what I'm talking about. Guys, so looking at the S&P 500, actually before we dive into the S&P 500 right here, guys, let's have a look at how the markets performed today. So the S&P 500, Nasdaq, both down 0.4% for the day, pretty much flat, right? But then look at the RSP, up 0.31%, and look at after hours, up nearly half a percentage point. Look at mid caps, small caps, IWM, they all gained as well. So it was smaller size, higher beta that really put in a lot of the work and added to a lot of the gains. Very broad based. I do like that, but take it with a grain of salt. Very thin volume across the board today, guys. Then if we actually dive into rates, now I know it says here 0%. Rates did move slightly higher on the day. Then we had Bitcoin up 3.49%. It's doing everything it should to go ahead and make new highs. I mean, yeah, we had a bit of volatility, but we can see we put in a higher high. We're breaking the previous high right here. All Bitcoin needs to do right now is stay above this high right here, break that high, and then we really are on the way to making, higher highs, higher lows, new all-time highs here in Bitcoin. Same thing with gold. Gold spiked very early on in pre-market session, but quite a lot of volatility you can see here on the day in gold. Nonetheless, green. We can see the same is true for silver, up 1.45%. Oil was actually down half a percentage point, but up from the day. Look at this volatility in commodities, right? A lot of volatility across the board, but let's dive into the S&P 500 because this is what everyone looks at, what we look at on this channel a lot. Now, looking at the weekly chart, not much to deduce from the weekly chart. Now, onto the daily chart, we can see a couple of glaring things. Number one, on the daily chart, we actually gapped up and then a lot of those gains that we made on that gap up. We did finish the day on a red bodied candle, so a win to the bears, I guess. However, we were pretty much flat on the day, guys. So the gamma flip zone right now is at 5200. Let's actually make that exactly 5200, right? So the gamma flip zone is at 5200 and we're slightly above the gamma flip zone. And I just quickly want to show you guys something on the 5-minute chart. You see this right here? That's negative gamma. You see all of this right here? This is positive gamma. And that's why in positive gamma, right, you buy dips, sell rips. In negative gamma, dealers sell into weakness, buy into strength. And that's why you get these massive volatile moves in negative gamma and compressed volatility in positive gamma. Now, what actually happened on trade today? Yeah, we traded higher and then slightly lower and then very, very muted. But if you actually look at the range in totality, it wasn't a very big range. So what can we expect tomorrow? Well, a couple of things, right? 5200 is a major line in the sand. This line right here, this yellow line. If we're above it, I do think that we're just going to buy dips, sell rips, and we're going to make our way to new highs right here. 5220, 5230, 5240 right here. And we're going to go ahead and break the actual open of Thursday when we had that massive volatile swing right before the jobs data. If we get below the 5200, and I know we're sitting right at it, I think we are going to be in negative gamma. If we gap below it, we could definitely see sell side all the way to these lows right here, Thursday, Friday lows last week. I think that's where we're going to definitely find support. It'll be constructively bullish if we find support above the low on Friday. If we do get into this negative gamma environment, we are in negative gamma and we can toss and turn at any point below the 5200. Above it, we look to these highs. Below it, we look to these lows. And this is your line in the sand right now for the week, guys, especially heading into that CPI print later on in the week. But in the greater context of everything, we are still in an uptrend. When you look at it, we just keep making higher highs, higher lows. And yeah, we did break that right there. But then you actually think of it, this is the new higher low, and we actually didn't break that low right there. We are moving higher. What really needs to happen now, though, is that we do need to go break some of these highs right here. Otherwise, we're going to be, doing a lot of balancing at the top of this range, which again, completely healthy, completely normal to do, especially with earnings season in full swing. I think a lot of stocks have run up quite a lot, and that could provide a lot of muted trade. Companies wait for earnings to see if a lot of the gains being made do materialize in their earnings. Now, looking at the weekend poll, guys. So next week for the S&P 500, are you bullish, bearish, or neutral? Do take into consideration, this is such a great contrarian indicator. Go have a look at the S&P 500 return last week, and then go have a look at the sentiment votes, and you'll know what I'm talking about. Now, this week, 47% of you guys are bearish, only 18% of you are neutral, 35% of you are bullish. So it's not even close here to the bearish side. If it was close, it'd be pretty 30-30-30, but it's not. So a lot of you are bearish. A lot of you see further downside after the S&P 500 dropped something like 1.02% last week. And yeah, according to you guys, we should see further weakness this week. Now, guys, despite all the volatility we've seen last week and in the last couple of days, we shouldn't lose sight of what normally happens in the S&P 500. And this right here is April's performance when the previous quarter or the first quarter of the year is positive. And you can see that a positive quarter normally leads to great results here in April. Average return 1.36%, 29 up years, 9 down years, and any dip we normally do get in April should be looked at as a buying opportunity, because for the most part, April does tend to finish positive, at least according to the stats right here. Now, that's not to say we don't get negative months. We definitely do. In fact, we've had 9 of them in the past 31 years. What you have to understand is that the positives outweigh the negatives, and normally this negative months in April should just be looked at as a dip buying opportunity, because oftentimes we'll get like a 2 to 3% down month and then we'll rebound, and it might still be like negative for the month, but this offered a great dip buying opportunity. So don't lose sight of the fact that Aprils are normally very positive, a very high hit rate, and any volatility we do get, you should look to capitalize on that. Earnings, guys, we have a big week of earnings. So on Friday, we have the big finance names, and over the next couple of days, we're just going to go through their expectations, starting with Progressive and JP Morgan Chase here today. So Progressive is expected to report $17.83 billion worth of revenue, a 24% growth, and look at these growth rates. No wonder the stock is up 30% year to date, and no wonder why your insurance premiums are up so much in the last year. And the company is expected to report 3.14 earnings per share, 300% growth year over year, and this is from 20 analysts. So very upbeat earnings. The stock has run up a lot, so there's a lot of expectations on this number right here for PGR Progressive. Looking at JP Morgan Chase, they're expected to report $42.42 billion worth of revenue, 10.61% growth on earnings per share of 4.28, and that'll be a 4% growth year over year. Again, 20 analysts. So guys, JP Morgan and Progressive are big hitters in the financial space. $42 billion and $17 billion worth of revenue just from those two companies. And if they do miss earnings, we could definitely see volatility here in these financial names. Now, looking at S&P 500 earnings. So according to Goldman Sachs, the S&P 500 is expected to report 3% sales growth, 3% EPS growth, and 11% gross margins. That would actually be 2 basis point growth in net margins for the S&P 500. So we're seeing earnings growth and margins expansion in the S&P 500. My earnings are a little bit different. Here in EPS, I have 5%, I have 4% sales growth, and then 37% year over year increase in margins for 11.4%, something like that. Now, let's say you want to buy growth, but you don't want to look at the top 10 names here in the S&P 500. What names can you look at? Now, these are 2024 earnings growth listed from number 1 to number 100, I believe. And the biggest earnings grower is actually Merck & Company. 2024 EPS growth, 472%, crazy. Eli Lilly in second, and then Nvidia here in third place. So Nvidia isn't even the biggest earnings grower in 2024. There's 2 companies above it. In fourth place, we have GE, then Progressive, by the way. That's why this company has run up. Look at this growth rate for the year, 63%. We then have Uber right under Progressive at 56% growth. Then we have Amazon, Netflix, AMD, and T-Mobile. And have a look at this. In the top 10 earnings growers for 2024, 2 of the Magnificent 7 are actually in here, Amazon and Nvidia. And have a look at Meta right here, number 11, very close second. So this is why these stocks have had such a great run in 2023 and continue to actually provide stellar returns. Amazon, Meta, Nvidia are all up north of 30% this year. Now, there's a whole bunch of stocks, sectors that you can look to right here. There's sectors, there's the S&P 500, a bunch of stocks that are also going to be declining their earnings growth, but looking at earnings growth in 2025. So a bunch of names. You guys can look at this list. It's going to be on my Twitter as well. So there's plenty of ways to play the S&P 500 apart from the Magnificent 7, guys. Now let's actually talk about the election. So we do have to talk about this because we're slowly making our way there. Time is flying, and we have Donald Trump and Joe Biden are going to be competing for the White House this November. I believe the election's on the 5th. And this week and over the next couple of months, we're just going to talk about their policies, what it could mean, how it's going to affect the S&P 500 stocks, the financial markets, the global markets. I have no horse in this race, but today we're going to talk about potential tariffs and what it could mean for inflation. Inflation is such a hot topic across the globe right now because we did have a cost of living crisis in 2022, and we are starting to still feel some of the ramifications of higher inflation. Now, in 2018-2019, tariffs were implemented when Donald Trump was in power. I do believe he's also talking about potentially implementing tariffs on Mexico, on China, to support the American worker. And this is what happened to CPI and PCE prices after these tariffs were implemented. You can see that inflation on those goods that were taxed went up dramatically. And this could be one point of contention that the Democrats could use against the Republicans. Now, moving on, Goldman Sachs estimate that a 1 percentage point increase in the effective tariff rate would boost core PCE prices by slightly more than 0.1%. So here are the components, as you can see right here, and the direct impact is just under 0.12. And if this is true, this is not going to look good for the inflation story as a whole. So that is if these tariffs do come in by Donald Trump. I don't know what the story is with them. I'm just giving you guys the data that Goldman Sachs has given to us right here. It's not my data. And we could see a stickier inflation, especially next year, as we continue the fight against inflation if we do get tariffs towards other countries that do trade with America. On the inflation front, we have CPI this week. The market is expecting a 0.24% increase month over month here in the CPI, and that should actually be a month over month decrease with regards to January's print and February's print, and we should actually see inflation gradually go down. If we do get anything more than 0.24, I think yields are going to rip and the market's not going to like that. So big CPI print this week, definitely something we have to watch. Now guys, this inflation print is very, very important because the market is super sensitive to macro events right now. You can see here that options on the SPX and NDX are pricing in a much bigger CPI move than average. This is since 2010, the last 12 months right here. This is what the SPX is pricing in. The same is true for the Nasdaq. This is since 2010, the last 12 months, and this is our implied move. and we can definitely see some volatility come into the market if CPI is to miss and come in hotter than expected. Now guys, let's look at some charts and technicals. This is something we got by the Lethold Group, and they say the market upswing is now confirmed by cyclicals, defensives, breadth, and bonds. Endorsement by all four occurs 1/3 of the time and has led to an S&P 500 annual return 15%. So guys, despite the volatility we've seen, the S&P 500 technicals and breadth look really good even at these valuations. Now let's talk gamma, guys. So very interesting developments. The very first thing we can see on the tape here is that negative gamma still remains very elevated. So there are still risks to this market in price moving lower, particularly if we do get to the gamma flip zone and below. Now we actually saw what happens when we get below the gamma flip zone last week. A lot of volatility, both to the downside and upside. And like I said, guys, in a negative gamma environment, dealers sell into weakness and buy into strength. And that's why you can have violent rallies to the downside one day and then upside rallies the next day. That's just what negative gamma is. It's an expansion of volatility. You see the VIX spike and you see rallies to the upside and the downside that can be pretty violent and can turn around at any moment. At the same time, we are still seeing positive gamma hold in there. The call gamma resistance continues to be 5,300, and this is where it gets interesting. And as it is right now, the put gamma support is at 5,000, the call gamma resistance is at 5,300. Now this is how this is going to work, right? If the 5,300 moves to the 5,200 strike, that's very bearish. If the 5,000 strike moves up to 5,100 or 5,050, that's bullish. If this moves up, that's bullish. What you really want to see is these two move in tandem. If this goes up and this goes up, that's super bullish. If you see them diverge from each other, expect more volatility. But if you see this move down and this move down, that is super bearish, okay? So you want to watch where these call gamma strikes reposition themselves in this week, next week, and leading up to OPEX. Those are the two major things you want to look at. And if price is above or below the gamma flip zone, those are the two major things you want to look to right now. Above the gamma flip, buy dips, sell rips. Below, just wait out the volatility. If you have a watch list, if your stocks get to attractive prices, buy the dip, sit out the volatility. That's my take on GEX right now. This is the S&P 500 average performance. Now this is the average bullish year, this is the average year, and this is the average bearish year. And you can see, guys, that 2024 has been, well, absolutely crazy. A lot of this run has to do with Nvidia. You can't deny the fact that market breadth has been absolutely fantastic. A little bit of sell side coming into the market, as you can see from the highs right there, but we are still tracking well ahead of the average bullish year. And can this continue? 100% it can. Although if we do get pullbacks, I am 100% a buyer, and I actually would love a pullback, a significant pullback, 10% in the S&P 500. Now looking at the current Nasdaq rally, right, compared to the last four moves off the cycle lows. So this is coming off the cycle lows. This is us right here, and we're actually underperforming the last four instances. While the S&P 500 for this year, we have absolutely rocketed up. The Nasdaq for the most part has underperformed what it usually has here in 1990, 02, 09, and then here in 2020. Let's have a look at a bunch of charts. This is the USA versus the world. You can have a look right here. Very linear returns since 2008. US stocks have just completely outperformed the developed markets and emerging markets as a whole. Now looking at large cap versus small caps, now we can see the trend right here again since 2014, the last 10 years. Large caps for the most part have outperformed small caps. The only time we saw massive small cap outperformance was here 2020 after the COVID situation. But since then, we've made a bottom and large caps have been nothing but ball all the way up. And that's not to say small caps have underperformed. Small cap quality has done really well. In fact, the index ticker CARF actually beat the S&P 500 last year in total returns, but it has paid to be in large cap in the last 3 years. Now looking at growth versus value, very similar situation. You can see that value here in 2022 has outperformed growth, but since 2006, really, it has been nothing but ball here for growth. And I do expect that to continue, especially with rate cuts and favorable economic conditions. Market cap weighted versus the equal weight index. And we are starting to see a double top formation right here. But for the most part, again, the last 10 years, it has paid to be in market cap weighted indices over equal weight indices, especially in the US. Now, I'm not sure if this is S&P 500 or if it's the total market, but we are actually getting to very close to the levels we saw here in 2008 And if history is anything to go by, we should see equal weight indices outperform the closer we get to this 0.95 level. Now looking at cyclicals versus defensives, and yeah, you can see this chart right here is telling us risk on. We bottomed at the end of 2022, start of 2023 right here, and since then cyclicals have completely outperformed defensives through the entire rally after risk off sentiment here in 2021 into 2022. Will this continue? I think it is, but I think we should see a little bit of a pullback, very similar to what we saw right here, consolidate and then continue the trend upward in cyclicals. I think it's a very favorable environment for cyclical stocks at the moment. But if you've made it up until here, thank you so much for watching. Guys, if you like this video, please subscribe, hit that notification bell and like this video. Also leave a comment for the algorithm. Cheers.